In today's webinar, we're going to take a look at calculating the return potential for an option trade using the option calculators. They're a great tool to help us determine the profit-loss potential for a trade before we take the trade. And as far as I know, I'm the only source for these types of calculators, and so I make them available to members, and it's a great source for when you're trying to decide which trade to take. You can plug in different variables, strike prices and option prices, and the calculator will calculate the return potential for that trade. So you can do this before you even take the trade. And we'll look at a few examples of option trades that we currently have in the inner circle portfolios, and you can see my thought process on selecting those stocks and strike prices based on the profit-loss potential that I got when I used the calculators before we even took the trade. Let's look at the option purchase strategy first. And of course, options consist of time value and intrinsic value. And when you purchase an option, the time value decays. So it's a wasting asset whenever you buy an option. So you always want to be aware of that. And the time value of an option, of course, goes to zero at option expiration. So it's going to decay over the life of the option more quickly as you get closer to expiration. So you always want to be aware of that when you're buying options. So you want to minimize the time value, maximize the intrinsic value when you're buying an option. And of course, the way you do that is you buy in-the-money options, and that allows you to minimize time value of the option. And I have a general rule of thumb: when you're buying an option, you want to try to limit the time value of the option to 1% of the stock price per month. So let's say you were buying an option for a $100 stock. 1% of that stock price would be $1. So you want to try to limit the time value of your option purchase to 1 point. And let's assume you were buying a 3-month an option with 3 months to expiration. Then you'd want to limit the time value to 1% a month, or $3 total. So if you're buying a $100 stock and there's 3 months to option expiration, you want to try to limit the time value portion of the option to $3. And I found that's a good way to keep the time value to a minimum and to maximize the intrinsic value so that you don't have a lot of time decay while you own that option. And let's look at an actual option purchase trade we made in the inner circle option portfolio for TJX. And since we made that option purchase, TJX had a 2-for-1 stock split. So all the prices I'm displaying now are adjusted for that 2-to-1 stock split. So we can see from this price chart for TJX that obviously it's in a price uptrend. The 50-day EMA, which is the blue line here, is above the 100-day EMA, so obvious price uptrend, and it's on a buy signal for the 50 and 100-day EMA system. It's also been making a series of new 52-week highs to confirm this price uptrend. And we have an upsloping OBV line that's in the lower portion here. So that is an indicator that this price uptrend can be sustained when you have an upsloping OBV line. And fundamentally, TJX has strong equity and retained earnings growth. So we had solid fundamentals and technicals for TJX when we made this option purchase. And we went ahead and bought the TJX April 2012 25 calls at 7.55, and these calls will expire, I guess, 2 weeks from tomorrow. And at the time we purchased the option, TJX stock was trading at 32.40. So if we buy the 25 calls and the stock's trading at 32.40, that's an in-the-money call. And what I do when I'm going to make a call option purchase is, in the calculator, you would input the stock symbol, the current stock price of 32.40, the option strike price of 25, and then the premium was 7.55. And then the other user input is this top line here, and we can input the percent change in TJX stock at option expiration. And in this example, I input the change in the stock from a 25% increase to a 5% decrease in the stock. So this top line here is, or this top row here is also user input. So once we put in the desired percent change in the stock price at option expiration, then we click calculate, and the calculator will calculate the profit potential both in terms of points and percent returns for these various changes in price of TJX stock. And for example, if TJX stock goes up 25% at option expiration, then this option purchase would realize a 105% return. If TJX stock is flat at 32.40 at option expiration, we'll lose 2%. If it's down 5%, we lose 23%. So the calculator is useful, and it gives you an idea of what the profit-loss potential is. And it'll also calculate the time value and the intrinsic value of this option at the time of purchase. So at the time of purchase, this option only had 15 cents of time value, and it had $7.40 of intrinsic value. So you can see it's almost all intrinsic value. So we're not going to have a lot of time decay with this option purchase. It's only 15 cents, and that works out to about 4/10 or about 0.5% of this stock price. So this is well below our rule of thumb, which is 1% per month. So this is a half, a little less than half of 1%. So we're well within that that general guideline of keeping time value to a minimum. So TJX stock today was trading around 40. So we have about 100% return in this option purchase right now, and we're as I said, we're coming up on April option expiration 2 weeks from tomorrow. So with TJX still in a strong price uptrend, with our trend confirmation indicators, we'll probably go ahead and roll this option over. And when we roll an option over, we reduce the cost basis and obviously the risk. If you reduce the cost basis, you're obviously going to reduce the risk also of the new option. And this allows us to compound our returns. And I like to use option spread orders in my accounts when I'm rolling over an option. And if you use a spread order, you can reduce your transaction costs, and you can reduce your commission and the transaction costs between the bid and the ask price for these options. So I plugged this into my trading platform yesterday. TJX was trading at 39.36, and this would just be an example of a rollover trade. And let's assume that we were going to sell to close. We're going to close out the April 25 calls, and then let's assume we were going to buy to open the July 30 calls. The trading platform will give you the bid and ask price for both the option purchase and for the option closeout. So the bid and ask for the July 30 call is, if you split the difference, is about 945, and the closeout of the April 25, if you split the difference, is about 1440. So if you're closing out the April 25 at 1440, and you're buying the 30 strike option at 945, then you'll have zero cost basis for this July 30 strike purchase. So that's an example of how it reduces the cost and your risk. So you could roll over into this July 30 option with no risk at all, because the proceeds from the sale of the 25 call will more than cover the new cost for the new option. So that's an example of how you can reduce your risk going forward and compound your returns. And I like to use option spread orders to roll over options, and so this has been working well with us. We've been able to roll over a lot of our current options, and again, by rolling it over, we reduce the cost basis going forward, reduce our risk, and increase our return potential. And here's a snapshot of the current option portfolio. This is as of a couple days ago. We had a $226,000 open trade profit and 214% average return. And as I said, a lot of these options we've been rolling over, and we've been compounding our returns. So this year we've been taking more option trades, more directional option trades than we did last year and in 2010, just because the market is trending better this year. Last year and in 2010, it was better to take spread trades that had a lot of downside protection because of all the price swings and the market volatility. But this year, the market's trending much better, so we're able to take more directional trades. And here's a snapshot of my current actual option purchase portfolio that I have in one of my trading accounts. And I have currently have a profit of $22,491, and that's on a cost basis of $11,346. So right now in my actual trading account, I have an average return of 198%, which isn't too far from our percent return in the inner circle. So again, the option purchase strategy is working really well this year as the markets are trending better. So this has been a good strategy for us this year. And let's talk about the option spread strategy. And with option spreads, you buy a call option and then you sell a call option with a higher strike price. And this is what's called a net debit spread, and your account is debited for the cost of the spread. And with debit spreads, you can't get into trouble because the most you can lose is the cost of the spread. And when you purchase an option and then sell an option, the sale of the option reduces the cost basis of the option purchase, and of course also reduces the risk. And I'll show you an example of that here of one of the trades that we have in the option spread trades we have in the inner circle portfolio. So in general, I like to do to buy in the money spreads for more downside protection. In the money spreads give you more downside protection, and they can still give you a great return potential. And as I said, we'll look at an example of one of the inner circle spread trades here in a second. So in the money, option spreads can provide good returns and downside protection at the same time. And these spreads can profit if the stock goes up or down or stays flat. And another important feature of these spreads is that it can help you maintain your position if the stock sells off compared to just a directional trade. So if you just purchase a call option and you don't do a spread, the stock price has to go up or you're going to lose money on the option purchase. But with a spread, you're buying an option and selling an option, and that provides downside protection. The short option profits as the stock's going down. So it provides protection if the stock goes down and can still be profitable even if the stock goes down, depending on the strike price that you sold. So let's look at an actual example of the spread trade. This is for Chipotle, and there's two ways we do these option spread trades. You can either simultaneously buy an option and sell an option, or if you have an option purchase and you have a profit in it, at a later date you can sell a call option against your current purchase to create a spread. So there's two ways to enter these spreads. You can either buy and sell simultaneously, or you can leg into an existing option purchase. Now, in this example, we bought and sold simultaneously on the same day. And this is for Chipotle, and you can see Chipotle's in a price uptrend with the 50-day EMA above the 100-day EMA. It's making a series of new 52-week highs. We have an upsloping OBV line, which is an indication that this price uptrend can be sustained. And Chipotle has very strong equity and retained earnings growth. So we had good fundamentals and good technicals with Chipotle when we took this option spread trade. And we went ahead and bought the June 295 call, and we sold the June 320 call to create a spread. And again, this was done simultaneously. And at the time, CMG stock was trading at 345.80, and the stock's currently trading as of 417. That was as of yesterday. So when I was thinking about taking this spread trade for Chipotle, I used the call option spread analysis calculator, and I input various strike prices here to look at the various scenarios for this spread based on the price of Chipotle stock at option expiration. So again, with the call option spread analysis calculator, we would input the stock symbol, the current stock price at that time was at 345.80. The buy strike was 295. We paid 68.20 for this 295 strike call. Then we sold the 320 call at 52.50. So when we sold the 320 call at 52.50, it reduced this option purchase from 68.20 to a cost of $1,570 or $1,570. So you can see when you sell a call, it reduces the cost basis of this option purchase. And of course, the short call profits if the stock goes down. So the calculator will calculate the cost basis once you input this data, and then this top row here is also user input. And in this top row, you want to make various assumptions for the percent change in Chipotle stock at option expiration, and I selected a 15% increase in the stock price to a 5% decrease in the stock price. And again, these calculations are based on the price of Chipotle stock at option expiration. So if it goes up 15% at option expiration, the stock will be trading at $397.67, and this spread would produce a 59.2% return. So the stock is actually above $397 right now, but at the time, this gives me an idea that this spread, even though we have downside protection, and if the stock remains flat at expiration at $345.80, we're still going to realize a 59% return. So, that's a great return for an option spread that has downside protection with it, and it allows you to maintain your position during price declines in the stock. So I was able to determine before we even took this trade what this profit potential was going to be. So that's what makes these calculators so useful. So we have a 59% return on Chipotle, and we're getting close to this 59% return. So once we get to about 90% of this return potential, then we'll either close out the spread or we'll roll the spread over. And it looks like with Chipotle, it still has good fundamentals and technicals. So we'll probably go ahead and roll out of this spread pretty soon here. And that'll be an opportunity for newer members to enter this trade. Whenever we do these rollovers, it's a good opportunity for newer members to get in on the trade. And so we'll be rolling this over shortly. And with the calculator, you can also calculate midpoint or towards the end of the time period for the spread trade. You can input the current price. This was yesterday's price for Chipotle at $4.17, and it'll show you the percent return based on various prices that you input for percent change of Chipotle stock. So even with a 20% decrease at this point, the spread would still produce a 59% return. And again, I ran this calculator based on yesterday's price. So let's talk about rolling over this Chipotle spread, which we will be doing in the near term. And with an option spread order, if you're going to roll it over, it would take two spread orders. In other words, you're going to close out your long call with a spread order like this. And this is based on yesterday's closing price of $4.17. You're going to close out the long option. We were long the $2.95 call. So you're going to close this out. You're going to sell to close the $2.95 call, and then you're going to buy to open. Let's say we're going to buy to open the July $3.50 call. So this could be entered as a spread order, and what this does is it closes out the long option, and then you buy to open the new option. So you can use a spread order for this, and again, you can save on transaction costs between the bid and ask price and also the commissions. And then it would take a second spread order, and with the second spread order, you're going to buy to close the current 320. We're currently short the 320 call, so you're going to buy to close that, and then you're going to sell to open, let's say, the 370 call. So we'll wind up, if we roll this over, we'll wind up with the June 350 and 370 call spread. So when we do that, the profit from the closeout of the expiring spread is going to reduce the cost basis of the new spread. So again, this reduces our risk and allows us to compound our returns. So we'll normally do this with option spreads as well as option purchases if the stock still has good fundamentals and good technicals. And in this case, in this example, Chipotle does, and we'll probably roll this over. So again, using the calculator before we even take the trade, we can get an idea of the profit potential for the trade before we even take it. And this has worked out real well for us. Here's the, as of yesterday, the profit potential, or this is the open trade results for the option spread portfolio, and we have a $163,000 open trade profit, average return of 181%. So the option spread trade strategy's also been working well this year, and a lot of these are rollovers, and we're starting to build up our profits in these spreads as we roll these over, and we're starting to compound our returns. So this portfolio is also working out well for us this year. And let's take a look at buy right trades. And with the buy rights, we buy 100 shares of stock, and then we sell one call option. And of course, when you sell that call option, that short call will profit as the stock goes down. And the sale of the call also reduces the cost basis of the stock. So if you buy a stock and sell a 5-point call option, it'll reduce the cost of the stock by $500. And buy rights can provide good returns and downside protection at the same time. And the buy rights can profit if the stock goes up or down, depending on the strike price. And just like the option spreads, the buy rights can help you maintain your stock position if the stock sells off, compared to just owning the stock, compared to just a directional trade. So these buy rights not only can produce a good return, but they also give you downside protection. So let's look at a buy right trade we currently have in the portfolio. This is for Core Labs, and with the Core Labs buy right, we already had a profit in the stock, and then we went ahead at a later date and sold a call option. And we can see that Core Labs, this is the major trend system. This is the 1 month price here, and this is the 20-month EMA. So we can see the 1 month price is above the 20-month EMA, so it's on a buy signal according to the major trend system. We can see it's making a series of new 52-week highs, and we have an upsloping on-balance volume line. So we went ahead and we bought Core Lab stock, and then at a later date, we sold a call option to provide downside protection for this stock purchase. And we had bought, originally our cost basis for the stock for Core Labs was $37.93, and then at a later date we sold a 110 strike call option to provide downside protection and income. And we sold that 110 strike call at 12.10, and that reduced the cost basis of the stock from 37.93 to 25.83. So the break even once you sell this call option with downside protection would go from 37.93 to 25.83. And again, with the buy right calculator, you would input the stock symbol, the current stock price, the call strike price, the premium that you receive for the call option, and then you input various changes in the percent change of Core Lab stock at option expiration. In this example, I did from 100% increase to a 10% decrease. And then you click calculate, and the buy right calculator will calculate the potential dollar profit in this row, and then the percent return in the bottom row. And we can see with these inputs, 100% increase in the stock would result in 193% return for the buy right trade. A 20% increase in the stock would result in a 76% return for the buy right trade. And then even if the stock declined 10%, we'd still have a 32% return. So again, we can use these calculators before we take the trades, and this gives us an idea of the return potential and risk for the, in this case, the Core Labs buy right trade. So actually, Core Lab stock now is trading around 133. So we actually have a 324% return for this buy right trade as of yesterday's price. And here's a snapshot of the current buy right portfolio. We have $178,000 open trade profit and average return of 146%. So some of these are rollover trades, so we're slowly building up our profits in the buy right portfolio by rolling the trades over. And this allows us to compound our return. So right now we have 146% average return, which is really good for the buy right portfolio. And there's obviously a lot of downside protection with all of these. So even if these stocks decline substantially, we'd still have a good profit. And I wanted to just show you a snapshot. These are my two of my personal accounts where I do buy right trades. And as of yesterday, I had $332,000 in open trade profits. So I'm going to show you just two of my accounts here. This top half of my account are the stock positions, and most of these are buy right trades, and then the bottom part is the short call options. So these are the short call options I have on these stocks. And here's the second account, and with the stocks listed on the top here and the short calls down here. So again, in two of my personal trading accounts, I have about a $332,000 open trade profit with buy right trades. So in summary, I just wanted to take you through the steps that I use when we're selecting these trades. And if a trade qualifies technically and fundamentally, then we will go ahead and input various strike prices for the option trade and then calculate what the profit loss potential is before we even take the trade. So the calculators are useful in that respect. So anyway, that concludes the presentation for today. And
Chuck, we have two questions, and I went ahead and placed those both in the chat, and they're also in the Q&A.
Okay. Okay. And Here's a question, how far in the money do you let your stock purchase price climb in a buy right before you sell a call against it? And would the short call be 1 or 2 strikes up? Usually, the short call, we usually sell an at-the-money call. If we already have a stock and we have a profit in the stock, we usually will sell an at-the-money call. That usually provides the best reward versus risk. And of course, at-the-money calls are all time value, so that becomes all profit at option expiration. So to answer the question, usually if we have a 20% or higher profit on the stock purchase, then we'll go ahead and sell a call against that to protect those profits. So usually about 20 to 30% profit in the stock, we'll sell an at-the-money call at that point to provide downside protection and income. And we also do the simultaneous stock purchase and also sell the call. We did one recently. So there's 2 ways you can do the buy right. You can either own a stock and have a profit in the existing stock and then sell a call option, leg into it at a later date, or you can simultaneously buy the stock and sell the call option at the same time, and we just recently did that for clean energy. Okay, here's a question. Can you explain how the short call provides protection on the option spread? Well, if you're short a call and the underlying stock declines in price, then the short call decreases in price. And of course, if you're short the call and it decreases in price, then that's profit. So as the underlying stock declines in price, the short option profits. So that's how that works. That's how it provides downside protection. And as we showed you in the example, when you make an option purchase, I think it was around the 68-point range for the option purchase for Chipotle. Then we sold the call at 52, so it reduces that cost basis from 58 to 16 points. So it reduces the cost basis, and then the short option profits as the stock declines in price. So that's how it provides downside protection.